Let's go. Hello, everyone. Good afternoon, where I am in Cyprus. Good evening in some other parts of the world. Good morning in other parts of the world. I am happy to be back for MOOC 17, Session 8, Central Bank Digital Currencies. It is great to see everyone. I hope everyone can hear and see me okay. And I hope you have had a nice time with Andreas Antonopoulos the last few weeks. And great to have everyone back here. So today's topic is going to be central banking and in general, central banking and cryptocurrency specifically. And really what I think is the most interesting thing on this topic is going to be the very famous CBDCs, Central Bank Digital Currencies. CBDCs are very, very popular these days. They're a very hot topic in the news these days. They mostly don't exist, but they're very much in the news, and they're very likely to exist in the coming years. And I'm going to do a little bit of some, general positioning on this topic, then we'll go to the questions. So the idea behind CBDCs is that central banks would give globally accessible digital currency. Excuse me. Now, this doesn't mean this is the first time we're going to have electronic money or digital money in a modern central banking system. In fact, most money is electronic, it's digital, right? If you think about where most of your own personal money is, you're probably not carrying it around in cash, right? If you think about how businesses operate, they are generally not. Think about Amazon and think about how much cash Amazon touches. None. All of the transactions at Amazon are happening through the banking system in a variety of databases at different layers above the base layer, which is Fedwire. Fedwire is the settlement layer, the real-time gross settlement system for the United States dollar currency zone. So let's think about what that means, right? Real-time gross settlement system. So real-time, it happens in real time. It's a gross system, so you don't net out transactions, and it settles. Once it's gone, it's gone. And so who has access to Fedwire? Well, financial institutions. You do not have access to Fedwire. You do not have access to an account at the Federal Reserve. Your bank has access to an account at the Federal Reserve, and when, at the end of the day, your bank transfers money to someone else's bank, ultimately the banks settle among themselves on Fedwire. When you buy something on Amazon, there's even a layer above, but ultimately, when all is said and done, some money will transfer between your bank and Amazon's bank on Fedwire. It's a complicated process. There's many layers, but all of those layers are already electronic, right? And this is one, I think, big topic that's sometimes misunderstood among the general public. Most money is already electronic. Most money is not physical commodity money that people are carrying around in their pockets. There's some of that. That's cash. That's it. well into the 90% are already electronic money in a developed economy. So, okay, since you already have that, what's the idea of a CBDC? Why does that exist? Why are people talking about it? Why might central banks want to do it? Why might central banks be thinking about doing it? Quite frankly, this came on the agenda post-cryptocurrency. Pre-cryptocurrency, you'd see some theoretical discussions of the type, should there be an ability for an individual, a company individual, but let's say an individual, to have a account directly with the central bank? Think about what that would mean, right? Like right now, there is no place I can deposit money where I will have zero counterparty risk. Counterparty risk is the risk that the counterparty defaults and you don't get your money back. Because when you're depositing money in a bank account, people's mental model is often that they're like, putting gold jewelry in a safety deposit box or something. That's the wrong mental model. What you're doing is you are giving a loan to the bank. You're coming and saying, I am lending Citibank $200,000. Now, it doesn't feel like that. It's not presented like that, but that's what it is. You're a creditor to Citibank. And in the United States, the FDIC, which is the mechanism by which banks provide some credit insurance, some deposit insurance to you, will insure your accounts up to $100,000. So the first $100,000, the federal government will step in to pay, and then after that, you're actually an unsecured creditor of a bank. And normally this is fine, right? Like most of the time, that works out fine. And then once in a while, it doesn't work out. Famously in Cyprus in 2013. And so there had been some discussion of the type, well, should we let people have accounts directly with the Federal Reserve, right? What's the nice thing about the Federal Reserve? Well, the Federal Reserve cannot default on a US dollar obligation. It's the only person who can, it's the only entity that for sure will not default in dollars. Now, the value of your dollars might fall. There could be inflation. You could take currency risk, but effectively default risk is unlikely. You're going to have this. So you say, oh, that might be nice. And then you say, oh, why did that happen before? Well, it didn't happen before because the Federal Reserve is over 100 years old. And how would an entity like that serve individual people? It would be very difficult. You needed, back then, branches and tellers and marble lobbies and people who would help you with your customer service. And it would be impossible for the central bank of the country to be running these things for hundreds of millions of people in the country. Today, it might be a little bit more conceivable in that you could just have an online account. But it's tricky because to some degree, the banks might worry that they get disintermediated, right? Because deposits are a relatively inexpensive form of financing to the banks, right? Banks borrow inexpensively and lend hopefully a little bit more expensively. The difference between the two is their net interest margin, and that plus fees that they charge is how banks make money. And so there's some question, some concern if someone said, that's fine. Particularly in a world where you're effectively getting close to zero interest anyway. It's fine. I don't need any interest. I don't need people re-lending my money. I'm just going to put it at the Federal Reserve. I want to treat it as kind of a risk-free place to put my money. And, there's some question if that's bad for the retail banking business. It's a very controversial topic. I think there's still an actual execution question there. Like, even if it is run an online website, keep it secure, have hundreds of millions of people with customer service calls, and, I lost my password, can you reset my password? If that's something the Federal Reserve or any central bank is equipped to do, the answer is probably no, right? But those are the types of discussions that were occasionally floated pre-crypto. And then with crypto, with a blockchain, all of these things I just mentioned are standard databases, right? At the bank, there is a database. There is someone in charge of the database. Database administrator, and then ultimately the CEO, and then ultimately the board of directors, and ultimately the shareholders who elect the board of directors, who elect the CEO, who appoint the CEO, who appoints the database administrator, and that's the chain of decisions by which something might happen in the database, right? And that's true for a commercial bank, but it's also true for a central bank. Fedwire also runs on databases in the normal standard model. And that's all we had until 2009, right? Like, the only place you could have recorded a series of economic transactions in 2009 was in a database. And then we had Bitcoin emerge and develop, and you see this model where something is natively digital. It has not one database administrator, not one single person who can change the database. And because it's programmable and open, people use it in all types of different situations. And because I've been around now in crypto since 2013, I have had a kind of view of the evolution of central bank thinking on CBDCs. And there was, something, it had been in the air, but in the beginning they didn't feel too much pressure to do it. It was one of these things that's like, maybe it will happen in 10 or 20 or 30 years. That's how we were like a decade ago, right? And then, well, maybe there's something interesting about this crypto stuff. Maybe there's something we can take away from it. But, it's not real money. It's a bad form of money. It's very volatile and dangerous, and mostly you should stay away from it. Right? Is the next phase. Some countries are still in that phase. And then what started to happen is people started developing private stablecoins. And those private stablecoins are effectively, crypto, but designed through a variety of methods of greater or lesser effectiveness, and with different risks embedded or not embedded in them, to represent the national currency. All right, so USDC, UST aim to track the price of the dollar. Why do they aim to track the price of the dollar? Because you might want to transact on decentralized, openless, permissionless rails, yay. But you might not want, for a certain application, to take on the exchange risk excitement of Bitcoin, where the price in your national currency changes every second. Right? There are absolutely applications where, I might want to tell Dimitri, I'm going to send you $100 for some reason. And I don't want to send you $100 as calculated as the exchange rate of Bitcoin at that exact moment, and then he gets it. But then, at the time he gets it, he's off making his dinner, and then by the time he goes around to exchange it, it's like $98, but he really needed $100 or something. No, I want to send Dimitri $100, just $100. Well, Stable coins are not bad for that, right? They tend to stay pretty stable so far. Now, there might be some systemic risk, and one of those days one of them might collapse. There's always been rumors about them, often about Tether. But I might want to send him $100. And so I can send him $100 in a stable coin. He'll get $100. And then there we go. Yay, problem solved. And these started picking up a few years ago, and now they're pretty large stablecoins. And this, to some degree, lit a fire underneath the central bank digital currencies. Because when it was just Bitcoin, you could look at it as a central banker and be like, goodness gracious, this thing's nuts. It changes price constantly. It's super volatile. I'm not sure people would necessarily use it. It's some weird thing. It's not a risk to my currency any more than the fact that, like, Tesla stock going up and down isn't a risk to the US dollar. It's no. Tesla stock going up and down presents no risk to the US dollar. Bitcoin presents no risk to the US dollar from this framework. But now if you see something that's $1 and works like $1, and its money supply expands like $1, and people start using it like $1, and then you actually don't know how stable it is, because in the background, who knows exactly how it's backed. You can, as a central banker, start to think, wait a second, if this is like, now they're $50 billion, but what if they become $500 billion or $1 trillion? And now this thing is acting like a synthetic dollar. It's like additional supply of dollars. And then maybe people are using them and feeling comfortable and treating them just like they're dollars, but maybe they're just, a private company. And then they have some problem, they collapse, they lose their peg. Maybe it's actually going to cause problems for people. And so this has led to two threads, I would say, coming out of central banks. One, there's a lot of regulation coming on stablecoins. They really don't like private stablecoins. Even the ones that can tolerate Bitcoin are not super big fans of private stablecoins. And I think are going to try and force them into some regulatory regime. That's number one. The second, the pace has picked up on developing their own CBDCs, because what this has shown is that there is interest in people transacting programmatically, directly, digitally, without an intermediary in, let's say, US dollars online. And that need is being met today by private stablecoins. And I think a lot of central banks think to themselves, well, that's something we should be doing, actually. We're in charge of monetary policy for the country. We're in charge of payment systems in US dollars. We want this running through our systems, and we want this, for quite frankly, particularly the United States, for two reasons. One, because sure, it helps you manage your overall monetary policy and economy and what have you, but also it is a form of power. The reason the US can sanction US dollar transactions around the world is twofold. Ultimately, they settle through the Federal Reserve, and the offshore ones actually settle through the Federal Reserve branch in New York. And in New York State has a law that says it doesn't matter where the people doing a transaction in US dollars are, and it doesn't matter how they settle or if they net it out or what have you. It is assumed to have taken place in New York, and therefore New York law applies, and therefore US law applies, therefore US sanctions apply. So which is why the US can say things like, yeah, I am going to prevent entity X, which in the last few weeks has turned out to be the Central Bank of Russia, from transacting in US dollars. You say, well, but what if they use US dollars and they don't go through the US? No, ultimately, the database of record for electronic US dollars is held by the Federal Reserve, and ultimately the US takes a position that that transaction happened in the United States. And so if this is your existing world, and now you're seeing people starting to see the growth of a shadow US dollar that's in private hands, it's decentralized, and may not be thought of as running through the Federal Reserve Bank of New York, you can imagine why this might be concerning. And so we've seen a pickup in pace by the Western central banks in exploring CBDCs. And if we think about, kind of what's the state of the world right now, China is the furthest along on this topic. And China has been building out a type of system of the digital yuan, which is viewed as being linked to their digital Silk Road type initiatives, and it's perceived, at least by outsiders, that it's a way to start binding other economies to the Chinese economy. It's a way to start binding transactions in other economies running over Chinese systems. And if it's running through Chinese systems and they have visibility of the transactions and the censorability of the transactions, it's a form of power, leverage, control, etc. And and they're fairly far along, and we have the ECB, the European Central Bank, has absolutely picked up the pace on this, has absolutely started setting up advisory bodies and consulting projects and roadmap planning for a digital euro. And then another step behind that is the Federal Reserve, which is now making some public noises of its wants to pick up the pace a little bit. They've been doing things, they've been doing some studies along the way. It's not like they're just starting. But they're making some noise that they want to pick up the pace. And so, I think it is safe to assume that this is coming. I think it is safe to assume that the central banks will do it. And then we get to the interesting question of what it is. And I think what it is going to be is not a permissionless public blockchain cryptocurrency. I believe the goal, as I can understand from statements of various central bankers or the board of directors or otherwise, is that ultimately these will be permissioned blockchains. So that, what do I mean by that? It means that if they decide that Dmitry should not be allowed to transact, this is in no way a suggestion that Dmitry is going to get sanctioned by the European Central Bank. He's a very nice guy. But let's say they did decide that. They would prevent him from making payments on a European Cbdc, a digital euro. Which would mean, for that to be doable, we'd have to know who Dmitry is. Which would mean that there'd have to be some type of account-based model, some type of KYC, know your customer, so that what you will end up with a system like this is still permissioned and KYC'd, as in the banking system, but with perhaps more end-user programmability, direct ownership in digital wallets by end users, as opposed to being in the database of the National Bank of Greece, and the emitter just logs into their website to make an entry in their database. He might have a wallet that looks like a crypto wallet, but there is a permission central flag that that wallet could be shut down. And I had discussions as early as 2013 with the Federal Reserve on this topic, and I had encouraged them to think about the value of a permissionless system. And basically, I think they had said, like, look, we can't have a system that's not KYC'd. And I said, well, but cash is not KYC'd. And I said, yeah, but realistically, this is going to be KYC'd. So I think our default expectation should be that these systems are permissioned, they are censorable centrally, and they are KYC'd. And then you go to another interesting dimension of, are they going to go direct to retail? Who's retail? Us, we're retail, right? That the system, you and I can have a direct account on there. And our account is just like Deutsche Bank's account. It just has less money in it, at least in my case, it will have less money than Deutsche Bank's account. Or if it's going to be a system where the banks themselves have accounts and we access them through the banks, that will look closer to the existing system. And the banks themselves and financial institutions, or maybe big companies, can transact directly among themselves, but we still go through an intermediary. Everything I'm saying now is my hypotheses on what's going to happen. This has not yet been decided. People are having active discussions about these topics. And so I'm making some guesses on things that may happen. But we don't know. We don't know what the central banks will do here. And I don't think they know yet. I think they're in the process of studying it. But I will say, I think it is absolutely for sure that the central banks have taken a greater interest to this topic than they had in the past. They're into it now. So I think we'll see a lot of action. I think we'll see a lot of studies. When I say there's a greater interest and they're going to move quickly, I don't mean expected in 6 months. I mean expected in several years. But it might be happening now. So I'm going to take a slight detour to current events to explain something that is a technical point, not a political point. Obviously, from a humanitarian perspective, the war in Ukraine is a complete disaster. But from a technical perspective of what types of things we're studying here, the fact that the ECB and the Federal Reserve were able to freeze the reserves of the Central Bank of Russia is just simply a standard outcome of a database. At the end of the day, US dollars, euros are held in a database, and someone's in charge of that database. In this case, the central bank. And so when the lawmaking entities in those areas decide to apply sanctions, or the executive decides to apply sanctions, they can tell the central bank, yes, do this. Just like I could say, deregister a student from the University of Nicosia, because you're a student at the University of Nicosia. If in our database, there's your name, there's your ID, there's the program you're attending, And I can, today it says you're registered, and I could turn you unregistered, or call our database administrator and say, turn them unregistered, or go through, realistically, a form that exists that academic affairs can do. And so I find that really interesting in that it highlights something that I think to a lot of people they don't understand. If you hear in the world at large, oh, this central bank has $100 billion of reserves in US dollars. And I'm going to be like a little bit extreme here, but I think this is right. Like, people kind of imagine, I'm not saying they exactly imagine like this, oh, like a big pile of money and they've stored it somewhere. I'm not saying exactly you're imagining Scrooge McDuck swimming through a literal pile of dollars, but sort of it's in that direction. But what is actually the case is that it's an entry in a database somewhere. In this case, in the database of the Federal Reserve. And none of this that happened is in the slightest bit of surprise to me, and none of this is a judgment if it's good or bad if this has happened. What I'm saying is, of course it's a database, and if it's a database, someone's in charge of the database, and whoever that person is in charge of the database can make changes to it, which the US did. The changes are, they didn't erase the entry in the database, they just said, look, we're going to switch off transactionability for now for this entry until we see if we can come to a better understanding with Russia about how to organize the world or what have you, right? So it's somehow, I think, a very topical and useful example of the types of things that, we discuss here, that everything is either a database with a trusted third party in charge of it, or a blockchain, or a public blockchain with nobody in charge of it. Those are the two options. That's where you can store information in a digital world, in a digital economy. And there's going to be all types of interesting questions, battles, policy discussions of what types of things should be stored in bucket one and what types of things should be stored in bucket two. So that is my initial comments on this topic. Let's go to some of the questions and see if I can maybe help with some of the questions. Programmable this is backwards. They're not CDBCs. CBDCs, central bank digital currencies. There are theories circulating that future CBDCs could potentially be programmed to limit their use to specific or approved merchants on an individual basis. For example, a clinically obese CBDCs could be programmed to disallow purchases from fast food outlets. Is there any credibility to this opinion? Sadly, I believe there is. Sadly, I believe when they're being introduced, they will not be necessarily introduced with this usage case. But I believe the mechanism by which they will be introduced will allow for this technically to happen. There have been comments by people in and around central banks that this is desirable. And things that have floated over time are like, well, maybe you'll get some type of government stimulus payment, but you have to spend it in a month, otherwise it goes away. Or you can't spend it on socially undesirable goods and services. I suspect that these are the types of things that will happen first. It's less going to be, hey, Polemitis, looks like you put on 5 pounds. We're going to need you to lighten up on McDonald's this week. Like, That's probably a ways away, to be honest. I think that'll be hugely unpopular politically. I think what is more likely to happen is that there will be stimulus payments there'll be payments that are designed to be spent in a certain period. And that I think there will be broad categories of undesirability, which is weird because, this already happened somehow in the banking system, but it's legal to run a crypto company in Europe and the United States, but it's all but impossible to get a bank account. It's kind of weird. But the banks say, I don't know, I don't want to take the risk, I don't want to get in trouble, blah, 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 and so can't get banking. And the central banks are kind of okay with that, and so they don't work very hard to force the banks to give banking. In fact, they kind of discourage them softly from doing it. And so I think there will be this type of thing for undesirable spending, whatever undesirable is at that point in time. And the problem with this, of course, is that what is considered socially desirable varies from time to time based on events. When the circumstances are what they are, people have different views on what's socially desirable in energy production. For many years, ESG was saying, transition away from oil and gas. And now there's a bunch of yelling at oil companies on why aren't they bringing more oil and gas online now? Well, basically, we've been telling society to stop doing that for a while. So, but I do think this is going to happen. I think that capability will be in there. I think once it's in there, it is going to be attractive to government to use it. Okay, that's an interesting question. I have a question with regards to CBDCs and the peg to fiat. Why does it have to be stable? Shouldn't there be dynamics of supply and demand in play? Physical cash has some storage costs, for example. Why shouldn't markets set a discount for an exchange rate, physical fiat to CBDCs? On the other hand, a CBDC may have some technical necessities like access to a phone or another e-device. This may lead to a discount for CBDCs. So again, my question, why do you think the peg needs to be one-to-one and not trade in a range set by the market? It's a very sophisticated question. I think the answer to this question, yes, it might technically be right that physical cash and electronic cash and CBDC money, electronic money and CBDC money, might have somehow different characteristics. But I think for everyone's practical convenience, nothing will be improved if they trade differently. You go to a shop, you're going to buy a bottle of water. The water says it's $1. If they say, oh, look, you're paying with cash, I have storage costs, I want $1.02. Oh, you're paying with your debit card, I want 99 cents. Oh, you're paying with your CBDC, I want $101.03, or whatever. All this is going to do, I believe, is basically annoy everyone for differences that are going to be very minor, because if they ever got out of line, there would be free money for someone arbitraging these differences and making the differences go away. So if someone said, if it became, we were like, oh, it's super annoying to use cash and I'll give a 10% discount for cash, someone's just going to buy up all the cash at a 9% discount, deal with it, and then turn it into electronic money at a 0% discount. And so I think these ranges, should they exist, theoretically would be quite small. Since they'd be quite small, it's going to add a quite lot of annoyance, transaction costs, for no real benefit, I don't think. So I don't think people are going to take that approach. Follow-up question. I don't think there's no liquidity risk. A central bank will set the money supply also of CBDCs as they do with their traditional monetary instruments. Just recently, there was a squeeze in USD collateral in the market due to the jump in volatility, so higher margin requirements. As soon as CBDC is eligible for collateral in some margin contracts, there should be a liquidity squeeze in CBDCs. That's, in my point of view, another reason why CBDCs and traditional fiat instruments should not be issued in a one-of-one peg, but should trade in markets. Pricing dynamics would settle such liquidity events, in my opinion. Look forward to learning your thoughts. I don't think there's any shortage of supply of CBDCs. I think the money supply of CBDCs will be very flexible when it's designed. And I think the correct way to think about money supply in a world of CBDCs is not that CBDCs are their own subcategory. I mean, let's say the central bank has whatever money supply targets. They're going to add up physical cash, electronic money, and all other ways they can create or destroy money and CBDCs and aim for whatever that target is. And because I suspect CBDCs for a while will be a small part of the overall money supply, I think they'll start small. I think they'll be able to adjust as they need to handle some things. It's my guess. I mean, we don't know. We don't know until we try it. There might be failure cases that we are, there might be failure cases that we don't know about. But I think that's how it's going to play out. Lecture materials imply that central bank features in the context of CBDCs or standard fiat include no credit or liquidity risk. But is that accurate? Isn't it possible for a central bank to borrow and lend on a global state-to-state level and then create some risks to the holders of its sovereign currency? Yes, but those risks show up in exchange rate risk. If a national government borrows in its own currency, let me give you the example more practically. Let's say I issue Polemitis dollars. And the way I issue Polemitis dollars is by writing my name on a piece of paper and handing it to you. There's no hard cap on Polemitis dollars. None. Zero. It's not like Bitcoin. And I borrow from you 1,000 Polemitis dollars. And you're saying, but yo, look, you spend a lot of money. You spend all your Polemitis dollars and you don't have 1,000 Polemitis dollars to give back. You're out. You're at zero. I say, oh, check this out. Problem solved. I'm going to write 1,000 on another piece of paper. Here you go. You've been paid back. No one's stopping me from doing that. I'm the issuer of Polemitis dollars. I decide how many Polemitis dollars there should be from time to time. It would be truly bizarre if I can just write 1,000 on a piece of paper and give it to you for me to literally default on a Polemitis dollar obligation. Now you might say, well, this is cheating. We're going to create a lot of them. Well, yeah, well, this is how modern fiat currencies work. If you do a bad job on this, if you make a lot of Polemitis dollars more than the market is willing to take, what will happen is people will be like, oh, Polemitis dollars suck. I'm selling them. Get me a real currency. I want dollars. What happens when more people want to sell something, or people want to sell something more in size than people want to buy? The price goes down. So you will have exchange risk, currency risk. The value of Polemitis dollars will fall. And hyperinflation is the extreme case of this, where countries lose control of this topic, can't keep up, keep printing more dollars to marks or whatever, Polemitis bucks, to keep up with the demands of them. And eventually people's like, I don't want any of this stuff. And so their value falls. And then when they want to meet obligations in a different currency, they have to print more of them. And then you get into a very bad, cycle. And so the pressure on countries to be sensible about their currency issuance is just this: the value of their currency doesn't fall, right? It's not like they can't make more. Of course they can make more. In the comparison between central banks versus cryptocurrency, there are several gap areas on the crypto sides. Monetary stability functions / exchange rate policy, financial stability and regulatory functions, prudential policy supervision, supervision oversight policy, operation functions, FX intervention, FX returns, lender of last resort. How critical are we to consider these gaps if we consider cryptocurrencies as a full and fair comparison with central banks? Oh, there are huge gaps. And I don't think private cryptocurrencies are the same thing as a national sovereign currency for a variety of reasons. I mean, think about these functions and think about in Bitcoin who exactly would do them. Prudential policy supervision and supervision / oversight policy. This literally means that the central bank will review the commercial banks in its country, check if they're being sensible with the rules, that they're not like lending too much money out to risky people, they have proper controls, analysis, all this stuff. Who exactly is going to do that on behalf of Bitcoin? Who? The core developers? And how are they going to enforce it? With what powers? The core developers of Bitcoin, anyway, aren't banking supervisors and don't have the expertise. I don't think have any desire to do this. But even if they had the expertise and had the desire, they can't come to me and say, oh, Polemitis, I don't like how you're using your Bitcoin. You're going to have to follow my rules on how to use the Bitcoin. These are acceptable Bitcoin. No, it's permissionless. They can't do that. They can't. It's built right into the system. Okay, what about intervention, reserves, lender of last resort? Price of Bitcoin is falling. I am going to go buy more Bitcoins with my US dollar reserves to prop up the price. Wow, it's not. There's no central entity in Bitcoin that's going to do that. And there might be individual traders who might try and move the price in a way they consider it favorable to them to move the price. But, it's weird. There's certainly not a central, lender of last resort. A lender of last resort is to prevent liquidity crisis. Banks owe you a bunch of money. They've primarily lent it out. They don't have it all available on hand. If too many people say, oh, give me the money now, they don't have the liquidity to give it to you, even if they're fundamentally solvent. The lender of last resort is a central bank. It says, all right, I'll give you liquidity so you can give the people on your side who need liquidity. I'm the lender of last resort. I'm replacing the depositors, right? I'm replacing the debt holders. They were previous lenders, but I'm the lender of last resort. Why can't the Federal Reserve be a lender of last resort in US dollars? Because broadly speaking, they can create US dollars. There is no one who can create extra Bitcoins. The mechanism by which Bitcoins are created is mining and solving that puzzle. And it costs a lot of money to do that. And any private actor who has generated bitcoins by doing that isn't going to be like, oh, wow, looks like Polemitis in trouble. Feel really bad. Let me lend him some of my bitcoins. I don't think that's what's going to happen. So no, Bitcoin's something different. It is not a classic fiat currency as fiat currencies have operated in the last at least 40, 50 years. Now, could you imagine a world, I'm not saying this is a likely world, but a gold standard type of world that says, like, look, I have Bitcoin reserves. Against those Bitcoin reserves, I issue a national currency, and the national currency is redeemable for that commodity good, which is Bitcoin. I mean, this is like the Bitcoin dream. I don't know if it's going to happen, but like, sure, there's nothing preventing that. That was the standard we had until 1973 in the United States, except for the word Bitcoin, just substitute the word gold. It was considered by the US before then that, like, you had to say, like, look, you can have this piece of paper, this electronic money, these things, but like, it has value because if you come give it to me, I'll give you gold back. Everyone likes gold. It's shiny, it's cool, you can make jewelry out of it. Nothing else like that. No. Let's skip that part. And it's been okay. Now, people say, oh, look, the price of gold in dollars has shot up. Yeah, because it used to be fixed and now it's not. There's more inflation. Yeah, sure. Okay, the price of things has gone up. Yeah. Does it matter? I don't know if it matters. I mean, it's true that these things happen, but it also hasn't been so far some type of disaster. Maybe it'll be in the future. The people who think fiat currency is doomed are like, oh, okay, well, maybe not yet, but later. Maybe. Maybe not. We haven't. 1973, it's 2022. It's almost 50 years. It's been okay. Because I know it's terrible. The value of the dollar is dropping, but the value of the dollar dropping a few percentage points a year because you know that it's dropping, that's something you can work around. Inflation's a problem when it's not 1 or 2%, but when it's higher, and when it becomes disruptive to the ongoing functioning of the economy. I say, oh, inflation was 8% in February. Yeah, that's interesting. We're going to have a lot of inflation this year. Now, is it because we've printed too many dollars? Maybe. Or is it because we have supply chain problems all across the world? First from COVID, now with the war in Ukraine. Yeah, probably more the latter, to be honest. Which means it's not easy to get rid of the inflation. Right? It's not like if you take away demand, all of a sudden the supply chain problems in getting goods from China to the United States are somehow going to magically go away. They're not going to go away. If you raise interest rates, will, Ukraine produce more wheat this year? No. So it's a weird. We're going to have weird inflation this year. We'll have inflation, and it will be supply-driven more than demand-driven, or lack of supply-driven, supply shock-driven. And so, yeah, and someone asked, is my thesis and what I just described about Bitcoin also applies to other cryptocurrencies? Yeah, it applies to any cryptocurrency. Any cryptocurrency, unless it's a cryptocurrency that is designed to be, it's hard to have a private cryptocurrency and say the supply is uncapped. Because if it was, it's unclear why anyone would want to buy it. Right? If I said, come buy Polemitis bucks, oh, how many are going to be? Unlimited. I will sell you 100, but later I might make like 10 billion. How much are you going to pay me for those 100? Very little, that's how much. Because the only Polemitis bucks aren't, de facto useful. You can't come and buy goods and services in Polemitis bucks. So maybe we can form the idea that there's a limited supply and it's a place to store value. But if it's a limited supply, if it's an unlimited supply, it's very hard to form the idea that this is a very good place to store value, because why wouldn't I let you all give me your money and then I just issue more Polemitis bucks to myself? And so generally private cryptocurrencies to succeed have to have limited supply. If they have limited supply, they can't be a lender of last resort, etc., etc., etc. So, and this has been, I think, pretty comfortably the case since we've started. Grab a question from the chat. Do you see CBDCs as being revolutionary in the sense that they will enable direct stimulus from central bank to citizen instead of QE today, where the central bank buys financial assets benefiting the rich only? Yeah, no, it's positive in this regard. Now, of course, people still do direct stimulus today. Like during COVID, the United States did direct stimulus and they sent checks to people, which it is kind of weird that that's the mechanism, right? It's 2022. Literally, the US government puts like a check in the mail, mails it to people. So, in theory, if there was a CBDC or an account with the Federal Reserve, and every citizen, you got everyone on board to have their account and their login and their password, all these things, which is a big project, right? Whether it's a CBDC or an account, it's a big project. It's a lot of like user education. And those accounts existed, and everyone had them, which again, it's a big project. Then you could press a button and be like, hey, cool, stimulus. Everyone now has $500 in their account. And so it's great. But it's not imminent. How do you get, even if you got like 75% of the country on it, you're still realistically going to have to cut checks to the other 25%. And think about all the different technophobes or people with irregular working situations or elderly. Are they going to really figure out how to use their CBDC crypto wallet anytime soon? Probably not, right? And in many ways, the most vulnerable groups are the least likely to figure out how to set this stuff up in the short term. Like, I'll probably succeed if there's a CBDC in setting up my CBDC account. But I'm not usually the one that trying to stimulate anyway, right? I'm trying to help people who are struggling. So, yes, it is helpful. It's one of the things that they like. It feels like we should get there, right? It feels like it's weird that I got a physical check from the US government. Now, they also, like, can pay your tax account, potentially. Like, a bank can pay your taxes from, et cetera, et cetera. But it's weird. I think it's weird. So, yes, it's a benefit. I don't know if it's revolutionary, but it's a benefit. There's a question about the People's Bank of China. The digital currency electronic payment system, or digital yuan, uses blockchain technology designed to function as cash and will be distributed through the nation's commercial banks, in addition to electronic payment systems such as WeChat and Alipay. I have two questions about it. Regarding its architecture, is it an example of two-tier intermediated or hybrid? Confession, I don't remember. I think it's hybrid, but I would not bet my life on it. And that would be a good thing for Dimitri or the broader team to check up on and answer. I don't remember offhand. I want to say it's hybrid, but I don't remember. And then, what's the strengths and weaknesses of account-based, DLT-based, centralist in orientation? Look, if you assume all of them are going to be permissioned anyway, which I think they are, the major benefit of it being blockchain-based is it's more likely that you will get developers building applications around it, right? I think you will end up with better software systems using payments if instead of having to, like today, let's say you want to integrate US dollars into your application. You either have to go to a credit card processor or a bank or some special company that's like an e-money company and get their API, get some permission from them, figure out how they implement. It's different from every single one, and it's generally clunky. If instead you had a system where, even if it's permissioned, it was a standardized electronic programmable system that anyone can connect to, even permissioned, I think it's actually good for improving the technical infrastructure of the permission system, because you can then operate on a standards-based method and everyone else is operating a standards-based method. And I don't know if you guys have seen, gals have seen, a company called Plaid, P-L-A-I-D, in the United States. It's a fintech technology company whose literally whole purpose of being is to give companies an intermediate service that lets them connect to people's bank accounts across like many different bank accounts. Because each of those other services are a complete nuisance, and so, I don't know, there's thousands of banks in the United States, and if you had to integrate with each one, it would take forever. So you just integrate with Plaid, and then Plaid does the integration in the back end. And so this complexity is unhelpful to efficient development, to standards-based development. And so if you're operating on a certain open standard, I think you'll get better outcomes. You could say like, well, what if you just had a centralized system with an API and you just went on and everyone used that API? Maybe that's possible too. But I do think there will be, given what we've seen with the success of people building applications on blockchain, I think we'll see systems in that direction. Now, those systems might be kind of hybridized blockchains. So the EU is doing something called the European Blockchain Services Infrastructure. It's interesting. It's slightly unusual. There's one node in every member state. It's kind of weird that way. We run the node for Cyprus along with the Ministry of Finance. And so it's definitely permissioned. And it's definitely, today in this trial phase, not particularly distributed. There's one node per country. But I think it's going to be these types of things in those directions. But nonetheless, my guess is it is better. You will be able to build a European application that integrates with this, which is different than building a European application, building a payment processing web page for the University of Nicosia that has to integrate with the credit card processor in Cyprus. And if I want to do the same thing for Estonia, maybe something different, right? It's probably better. So I think on CBDCs, you will pick up, whatever their other strengths or weaknesses, you probably do pick up some efficiencies relative to the current system that's really quite inefficient. Okay, I think that's it, both on the questions. I think I got them. And we're towards the end of our time. So I hope that was interesting. I think it is a very interesting topic, CBDCs. It's not exactly core crypto, but it's inspired by crypto, somehow related to crypto, somehow some of the ideas of crypto, but not all of the ideas of crypto, and like a lot more of the ideas of central banking, but with a little bit of crypto flavor. And so it's a thing. It will be an area of development. It will generally, I think, be a positive thing regardless, but we have to watch for certain things. Like if everyone ends up in a permission system, I think you do risk the censorship aspects being too strong, right? Like imagine a bad actor in charge of a central bank, and that bad actor is concerned about, doesn't like a certain industry, just because of this bad feeling that there's. Just like, oh, this industry can't have payments. They can do that. It's kind of weird. It is kind of weird, to be honest. So I think there's going to be these balancing acts of like, where do you have fundamental rights in CBDCs? Where is it just a totally permission system? And how to think about these two topics, I think, is going to be a very interesting trade-off, along with all the other technical architecture trade-offs. And so we're going to go into an interesting world this decade. So again, thank you everyone for joining. Come next week on regulation. It's really interesting, even though none of you guys are ever going to. You will not show up, but you should. It is way more interesting